Hello, this is Ken Tomka with T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these videos for trading purposes. They're for information only. If we look here, start with the weekly chart, the big picture. This goes back about 6 years on the S&P 500. See a nice sell-off here in early part of this year, but really off to the races after that. Really strong dip there, but off, and we're at all-time highs here, just rolling right along. Doesn't matter what people are concerned about a recession, anything like that. It just all systems go. I highlight the trend line on there, and also a support point, what I would expect if we sell off, where the market might look at stopping that progress, but not really seeing any of that right now. We're all systems go and moving higher. If we come down to daily chart, look at it in a little more detail, put the trend line on there, and see some of our moving averages. There's a 200-day moving average down here, the 50 and the 21 also on there. Same thing, nothing to see there that looks like any kind of problem. It's just all systems go higher. Really, overdone. I mean, if you look at this, we've got 1, 2, 3, 4, 5, 6. It's 6 months just straight higher, grinding our way. Come down here to a 2-hour chart. This gives us about the last 6 months trading on the markets, and you can just see that. I mean, sure, you get these little dips here, but nothing but uptrend. It's just been pretty steady there. Remarkable given how overvalued the market probably is, but you don't want to argue with the market. You just follow along with what it's doing. We look at some of the, actually, let me go back here. We'll look at some of the internals in the market. This gives us an idea of some things underneath. This is the percentage of the S&P 500, the bullish percent that's in an uptrend. And right now it's 59%, which is a little light for a market at all-time highs, just rallying away. What this basically says is that a little more than half of the stocks in the index are in a rally. We'd want to see that much higher, 80, 90. It's a broad market rally, but I think what's happening is we're getting certain AI stocks are really lifting the market and making the indexes go higher. Same thing here, the advanced decline line on the New York Stock Exchange. It's daily compounds with the advancers minus the decliners, and that's been kind of flat. So really what we are seeing is that there are just some stocks are really bringing the index higher, but kind of flat for everything else. We're not really sure there. And then finally, at the bottom here, we have the VIX, the volatility index, and this is what the price that people are paying for puts, protective insurance on their portfolio, and it's pretty low right now. We're sitting in the mid 16s. So you'll see in a big sell-off like there in April, you'll see it come up to 45, and if we look, that's when the market was at its low in the beginning of the year. So not seeing that pop up just yet either. We look at some of the other internal measures, the ratio of consumer discretionary stocks to consumer staples. That is still going higher. So people are picking consumer discretionary stocks instead of the safe staples stocks. Technology over utilities, same thing. In a rallying market, we'd see technology stocks doing better than utilities, and we're still seeing that. Maybe a little weakness there, but still seeing it. Biotech over healthcare, definitely big uptrend there. And then finally, hotels versus utilities. We would expect hotels to do much better than utilities in a rallying consumer-driven market, and we are definitely not seeing that. Although I know anybody who uses a hotel lately, that wow, they've gotten really expensive. So we are seeing a little bit of decline in that index there, but nothing. The fact that the rest of them aren't really doing it, it may be something specific to hotels. We look here, interest rates. This is the interest rate on the 10-year U.S. Treasury bond, and you can see it's just been flat, same place for 3 years here, just bouncing around between the high 3s and the high 4s, sitting at 4.11 right now. So nothing happening there. Interest rates are just staying still. These are not the rates that the Federal Reserve controls. They just control the short end of the market, that one year rate kind of thing, but when they act or don't act, it should have influence on the longer term bonds, which this is the 10-year, and we're not really seeing any movement there. If we come down and look at economic indicators here, GDP growth rate, last read, that's a pretty good number, 3.8, popping out, especially you had a negative one print before that. So that's pretty good. Non-farm payrolls, the jobs number, that's pretty weak. I mean, we're just staying above zero there. Inflation rate around a little under 3. That's, a little high, but it's fine. Retail sales barely above zero. So these are not great numbers. But also with the government shutdown, we have to know that there could be adjustments being made or reports that aren't even happening right now. So something to keep in mind. Finally, if we look at valuation on the market, this number right here, this line would be 20 times earnings for the S&P 500 at 44.50. We are now trading at 67.52. If we counted 20 times or maybe a little higher, 25 times, you can see that the market is definitely overvalued based on that thing. Again, I've said it before that that could stay that way for quite a long time, but it is something to keep an eye on. This market's definitely very expensive. So anyway, hope this was all helpful and informative, and appreciate you watching. And if there's any questions that you'd like to see in future videos, please let us know. I'll put up contact information here. And also, if you'd like to hear about what we're doing in our portfolios for clients to match some of this, please feel free to reach out. Otherwise, thanks so much for watching, and we'll see you at the next update. Thank you.